Hi, this is Stock Mommy. Today we're going to be doing a video on options trading. Basically what options trading is, it allows you to take a larger position in a company without putting in as much money as buying a stock outright. Okay, so just get into your Robinhood app, and I want to point out that not all stocks have options trading. For instance, NVCN does not. The one that we're going to be looking at today is Ford. They do trade options. So you hit trade options. The first thing that you see is an expiration date. This is one of the biggest difference between buying stocks outright and buying options. Options expire. So you have between now when you buy it and June 1st to sell for a profit or for a loss. Okay? The share price currently is at $11.50. That's a strike price. So we're going to buy an $11.50 call today in the example. A call is for if you think that the stock price is going to go up, while a put is if you think the stock price is going to go down. This makes it so that you can make money on the upward and downward trend in the stock market. All right, so let's click on this $11.50 call. We think the price is going to go up at this point. One contract equals a control over 100 shares. I usually buy 10 contracts, so I would have control over 1,000 shares. Right now, the limit price is at 12 cents, or you can put it at 11. If you decide you don't want to pay 12, wait for it to go down. It won't execute until it gets to the price that you put here in the limit. And then your cost at 12 cents is going to be $120. So basically, you're paying $120 for the right to buy 1,000 shares of Ford for $11.50 per share by June 1st. If shares are not $11.50 or higher on June 1st, these options will expire worthless, which is what we just talked about. Okay? Then you would swipe up and hit submit. And from that point on, you have control once this order executes. Okay? So now let's look at a put. If you said, oh no, I think that Ford is going to go down from $11.50, so I'm going to buy a put option. Your break even would be $11.40 on the $11.50 put. I just wanted to click that really quick. And it's 10 cents. Now, when I say break even is the price that the stock needs to drop to in order for you to break even on your investment. You're basically buying this out of the money, and you're expecting for the option to drop to where you break even and you start to make more money. Okay? So 10 cents, and let's say you do 10 contracts, that was going to cost you $100. And once this order executes, you have control over, let's review, you're paying $100 for the right to sell 1,000 shares of Ford for $11.50 per share by June 1st. If the shares are $11.50 or lower on June 1st, these options will expire worthless because you're betting on the stock to go down with the put option. Okay. Another thing I like to click on is right here to the top right corner. You can see the chance of profit. You can see the volume amount of contracts that were bought the last trading day, and you can also look at the open interest, which is basically how many contracts there are outstanding out there. Okay. And that's pretty much it. That's trading options. If you have any other questions, please leave it down in the comment box. But that's it. Buying calls and puts, selling those calls and puts, and basically being able to trade for a lot less than buying stocks outright. So if you have any more questions, just please let me know. Thanks.